Those comments from the Fed chair rippled through the housing sector. The idea being that if the Fed cuts interest rates, mortgage rates will dip, making home purchases more affordable. Lower rates would also offer some relief for home builders who have seen higher labor and land costs, giving that sector a lift today. But there is another shift underway in the housing market, and the change may be bad for buyers. Diana Olick explains.
It's all about supply. We've been in a pretty severe housing shortage for the past several years, which meant that as demand rose, prices did as well. But this year we started to see more listings and prices easing, but that may be short-lived. Supply is expected to drop again this fall and potentially hit a new low, according to Realtor.com. Inventory gains began to slow this year from 6.4% growth in January to 5.8% in February. Gains continued to slow throughout the spring, and supply was up just 2.8% annually in June. It's now expected to flatten over the next 3 months and could hit its first decline in October of this year. Of course, all real estate is local. The housing shortage is worsening in smaller, more affordable markets like Oklahoma City, Memphis, Raleigh, Richmond, and Pittsburgh, according to Redfin. But in pricier markets where demand has fallen off, like Seattle, San Jose, Denver, Chicago, and Boston, the supply of homes for sale is increasing. A looming shortage could help the home builders, but they still need to either lower prices or build more entry-level homes, because that's where demand is strongest and supply is leanest. For Nightly Business Report, I'm Diana Olick in Washington.